My name is Brent Cook. I'm an exploration geologist, economic geologist, and co-author of Exploration Insights, which is a newsletter Joe Muzumdar and myself write that basically talks about what we're actually buying and selling with our own money and some perspective on the markets and things we're seeing out there. Last year we visited 30 projects. This year we'll probably get close to 25. So we spend a lot of time on the road. What I want to talk about today is exploration due diligence, and geology does matter. And I'm using that title, Geology Does Matter, from a PDAC a few years ago. The presenter before me across there made the comment that geology doesn't matter, to which I responded, it actually does. All right, so how many of you caught Joe's talk yesterday morning? All right, so being I'm from the US, I thought it was important to come up to Canada and bring you some alternative facts to get going. So Joe is all about this Cretaceous tertiary extinction event, right? Well, as you can see here, creation started about 6,000 years ago. We had Noah's flood, and the population has gone up since then. And here's the alternative version of what actually happened. All right. Good. All right. And just quickly, the companies that Joe and I own, or they're in the exploration portfolios that are here at this show, these are the four of them, just so you know that's what we do own. Okay, where we're going today. We're going to do the big picture, talk about gold versus US dollar. Won't go into a lot of that detail. I think we're all on the same page there, more or less, and a lot of people can do it way better than I can. Then we're going to look at more important aspect to me, what's the key to why this sector is going to do well over time, mine supply versus demand. And then the third part, it's been suggested I should retitle that, is how many people can I piss off in 20 minutes? All right, so the big picture. My view, from everything I've read, is the market is rolling over. And we're right at that point there, I think. That's us right now. It's been a record bull run since 2008. A lot of that stock momentum, I think, is driven by stock buybacks. That's where there's been, $910 billion in 1918 alone was share buybacks. Negative corporate cash flow. This is a surprising number here. This is a print of stocks in Canada, Australia, et cetera, that are negative cash flowing. Canada wins with 82%. I guess that's got to do with all the mining companies. Australia's second, but the US, 58% of the companies listed are negative cash flowing. That was surprising. That can't be a good sign. And finally, foreigners are backing away from US treasuries for a lot of reasons. But you can see here the bottom chart shows foreign central banks sells since 2014. And you can see they're selling a lot more over time. That has negative implications to me to the US dollar. I think we've reached peak Trump. Confidence in the US dollar is declining across the world. We've alienated our allies. We've got trade wars, policy uncertainty, what I'm calling directionless chaos. And this Trump-Mueller investigation is going to get ugly. So that's a negative too, I think, for the US dollar and confidence in the US. More important, metal demand is not going away. And I think this is really, we all know this. What you can see here is how metal demand has increased over time. And copper production for all history, and then you can see that it's forecast to double over a short period of time. The second important point, production or demand's going up, discoveries are going down. This is all metal discovery. And you can see even with estimated production or discoveries, which is in the light gray, they're going down. And there's a lot of reasons for that. And this last little slide here shows the percentage of discoveries that have been put in production by decade, more or less. And you can see that the earlier, 72% of the earlier discoveries from the years 1950 to 60, 72% went into production. Since 2000 to 2016, we see about 18% of those discoveries put in production. So there will be more coming into production, but just realize it's taking much, much more time to find these things, delineate these things, and put them in production. And the problem is the odds are just basically low. And on average, a study by Newmont a few years back it estimates that 1 in 1,000 prospects actually become something economic. Now, we obviously can improve that quite a bit, those odds, by doing the due diligence, which is where we're going next. But consider for every 2.5 gram deposit that was formed, there's probably 10 1-gram deposits. So we're going to find 10 1-gram deposits for every really good deposit. When you start looking at depth, and you've got all these other issues on top of that, the odds are just going to go down. They're deep, they're covered, drilling costs are higher, metallurgical issues come into play. You've got big strip waste issues to deal with, water issues, either there's too much or not enough. You're disturbing a large area, they've got more complicated permitting, higher capex, and down there I've got the bottom. How much does it take to disprove a discovery? That's a really important thing to know if you're running a junior exploration company or investing in one. How much is it going to cost to prove you're wrong? So your job, our job, I guess I should say, is to recognize success and failure ASAP and kill a project as quick as you can. So to do that, you need to know the geologic parameters, the likely metallurgical process, funding requirements, what's it going to take to get to the next level, if you will, of your investigation. Because you're really testing a thesis, right? You're testing a thesis and you get the data back, is your thesis good or is it not working? You need to know that as soon as you can. So when to stop and when to continue. Know the economic parameters. If your company is looking for a porphyry copper deposit in the Golden Triangle, they should have a sense of what their capex is going to be to build something there if they're successful. You've got to know that if you're looking for something. Otherwise, you really don't have any clear idea what you're looking for. And then, of course, the social and environmental limits. I remember I went to a project in Colombia that looked really good on paper, but you get there, and here's the project, and just up the hill is a beautiful white church. So it's not going to happen, regardless of the grade. Is success meaningful? That's really important as well. I think, from my experience, too many companies are looking for projects that, even if they're successful, it doesn't have a meaningful impact on their share price. I would give IDM as one example of that. Successful, found a deposit, drilled it out, sold it, share price didn't do anything. So that's what, does it translate into a share price increase? Basic due diligence checklist. I'm not going to go into this in a lot of detail. You're welcome to email us and I'll send it to you. And I think most of you are pretty familiar with this sort of thing. But again, money, who cares? Is anybody going to care if this is successful? What's the project? Share structure, really, really important. Management, committed, honest. Those are two good qualities, I think. Okay. Let's talk about economic studies now. That's what a lot of people work towards, a lot of companies work towards, a preliminary economic assessment, a pre-feasibility, feasibility. This kind of shows what the level of accuracy you should expect on these levels of studies. For a PEA, you're plus or minus 30 to 50% in your estimates. And it's rare, if ever, that I see one that undersells a project. They always make it look better than it should. With a pre-feasibility study, you're plus or minus 20 to 30%, and they're usually, in my experience, over-optimistic. And then you get down to the feasibility study, and in general, they should be pretty close. If you've got a good engineering firm working on it, and you're using good, solid economic numbers. All right, let's talk about one that went wrong. This is Golden Queen Soledad project in Southern California. I put a star on the share chart that shows each time a feasibility study was done. They acquired this in '85. They did 4 studies. Last 2 weeks ago, they sold 50% for $37 million, of which 26 of that was a loan was canceled out. They had a cumulative deficit of 87 million and a market cap at that time of 8 million US. 4 feasibilities. Okay, the first feasibility. How many feasibilities does it take to fill the Albert Hall? All right, so in 1996, the first feasibility study, they identified 791,000 ounces at 0.91 grams. The base case study assumed a $375 gold price, capex at 59 million, and the cash cost came in at 230. So there's what? There's your profit margin there between 375 and 230. Next study, 2000 feasibility study, 1.3 million at 0.84. They tried to make it bigger, used a $300 gold price, and it turned out marginal. 2012, another study, more ounces, less grade, 1,300 gold. I didn't see after tax, but the pre-tax NPV at 8% was 787 million. Fantastic IRR of 83%. And the capex at 119 million. So that's what that came out as. And then 2015, the final feasibility they did, million ounces at a gram, $1,300 gold. After-tax NPV at $214 million and 28% IRR. And the thing got sold for, well, a market cap of 8 million. What went wrong? Mining reality is often different than a spreadsheet. And that's what most of these companies work on, is a spreadsheet. The grade came out all right. Recovery was much lower than anticipated. And ended up they lost 13 million versus making that 274 million before it was sold and shut down. So that's the cross-section through the deposit. The green is the cutoff grade, which is 0.3 grams. So green and red and yellow are what make the grade, and the rest don't. So let's look a bit at that, what the deposit really looks like. And this is common sense. I think, isn't not that hard to figure out. It's common sense. But look at this thing. The mineralization is actually pretty narrow. There's a lot of white, which is barren. There's a lot of blue, which is waste. So you can look at that and see this is going to be complicated. Most of the good rock is deep, which means your top, it takes a while to get your payback. You really want the good grade at top rather than the bottom. So this is something you could look at and say, this is probably why it went wrong. Wrong assumptions. Let's jump over to another. This is a project down in Brazil, Arizona, that Equinox has. And I want to show the difference between a resource strip ratio, pit-constrained resource estimate, which is here, and the red, I should say the gray is what was assumed in the resource estimate, and the red line is what came out in the pre-feasibility study. And you can see that difference there. All that rock between the red and the gray was not assumed to be in the initial estimate, and that's got to be moved. That's extra cost. That's extra strip. Down here, same thing. What you can see is the resource went much deeper than the actual pre-feasibility took it. So you're losing ounces at the bottom, and you're gaining strip at the top. So that's the difference between as studies go along. Is this making sense? Okay. All right, let's look at the Eleanor deposit. Acquired by Goldcorp for $406 million, 2% royalty, et cetera. This is a fantastic discovery. They put $1.6 billion into it, but it hasn't turned out as they expected. The reason being, they did not understand well enough the structural controls and the structure of the mineralization. You can see the indicated shape. This is what they sort of assumed it looked like when they did the resource and feasibility study, or pre-feas. I think it was feasibility. Anyway, it assumed it was a nice continuous unit. As they got more detail, this thing's starting to wave. When they really got down into it, this is what it looked like. And look at those drill holes. How would you join those up if you didn't have that red in between there? So this is sort of what's gone wrong there, is they didn't have enough detail on the drilling. Let's do one more feasibility. Rubicon. This is sort of a schematic that shows in 2013, this was the model they were using, and all the red is considered ore. And this is just how the model worked. So that they ended up with, 1.3 million ounces at a good grade, and a 1.1 and then 2.2 inferred on that model. But the more drilling they got into it, you remember this thing crashed. The second set of drilling turned out that only, most of that red turned out to be green, which is waste, barren. So that dropped the ounce count down by an order of magnitude to 0.1 ounces, or 0.1 million ounces. And in 2013, they reinterpreted the structure, more detail. And you can see again, the red is the mineralization, and yellow is a mineralized breccia. So you can see between the initial here and here how much more complicated it's got with the more detail they got into it. As you can see, that's harder to mine, eh? That's a cross-section showing all the holes into this thing. I left shaft on top on purpose. And this is how the stock did. Over that period of time, you throw out the rollbacks and such, it went from $240 to $138 in 3 years. Another one, and these are real life examples I'm giving you. On this side, you can see the interpretation that was done by those drill holes. Looks fine, but with more drilling and more work, you can see what's happened is it was not, in fact, some lenses like this. It was a number of discrete structures like this. And if you go down on that, either open pit or underground, you're going to be really sorry. So, this was actually someplace in Bulgaria. All right, how to make $1 million in mining? Well, start with 22 to 20 million. This is an example of one of the stocks that we lost money on in Exploration Insights, Glass Earth Mining. Very prospective land package in New Zealand, adjacent to a mine that produced 10 million ounces and needed more ore. Geophysics, everything pointed to this is a great project. And it was a joint venture between Newmont and Glass Earth, 65-35. But Glass Earth had to contribute their 35% in drilling this thing off. And this is what it looked like, the geophysics. You can see the drill hole. You can see some, 13 meters at 4 grams, 3.2 at 37 grams. Big alteration system, just like the deposit next door. So it's good. Massive alteration system, good hits. And what went wrong in Exploration Insights? And I pulled these quotes out of the letter when I wrote it. I said, normally, I would run for the hills at the very idea of an exploration company attempting to offset exploration costs with alluvial mining. And perhaps ultimately I wish we did. Nonetheless, oops. And at this point, our speculation is much about management of properties. If the alluvial mining fails to generate project revenue, management screwed up and will probably sell. You can guess what happened. They didn't control their destiny. Newmont was in charge of the drilling. Newmont was not attacking aggressively. They would do one hole every 6 months, more or less. So these guys had no news flow, couldn't raise money. It was a bad market. They had no skills. They were based in, no marketing skills, based in New Zealand. And our investment thesis, my investment thesis, changed from this is what we got to see to, God, I hope the alluvial mining works and they can get another drill hole into this. So we bought it at 37 cents, sold it at 15, it went bust. So when is success failure? So this project was in, the adjacent mine was bought by Oceana Gold. They picked up this project as well. Last year, the president, latest WKP results support significant existing exploration program, et cetera. You can see the drill holes here, 8.7 meters at 24 grams, 7 at 11, 1.2 at 58. So Oceana's working this project. They're having a lot of success. This is what it looks like in section. They've announced an initial resource of 234,000 ounces at 18 grams and another 401 at 12 grams. So the concept was a success. We knew what we were doing geologically, but we didn't know what we were doing in terms of how the company would play out, how they could actually be successful and raise the money at higher prices, et cetera. They didn't control their destiny. So that was a lesson we learned. All right, so when is failure success? Here's another one, Evrim Resources. This is a stock we bought back in 2015 at around 10 to 15 cents, accumulated over time. Here they made what looks like a very nice discovery. Let's see if let me go back. So they made just based on surface trenching and stuff in Mexico, very nice, came along here, up here, and then here's when they released the results. Straight from 122 to 30 cents in a day. There was no way to exit that thing. Project, good project, big alteration system, never been drilled. On the top we have the good zone of samples, good grade. We knew what the system was, thought we did anyway, epithermal, high sulfidation, oxidized, ideal for mining, just like El Sasal. So we knew what we were looking for. The rocks looked like this, all good. Trenching was good. They did a good job of that. Great trenches, 193 meters at 2 grams, 156 at 9. Yeah, this is what you want to find. It's oxidized. And this is what went wrong. Geophysics. Geophysics will always guarantee you an anomaly. It will not always guarantee you an economic deposit. So the geophysics, the blue, is silicified material, the alteration we're looking for, and our assumption was that that probably represents the mineralization we're looking for. Well, it turns out it was silica, alteration, but no gold, hardly any gold. So that's kind of went wrong. But I will claim this as a success of sorts in that we bought good people at a good price, doing a good business. Took us this long, we're buying in here. We added some here on that initial discovery. We recouped all our cash here and made some on top of that. Newmont put money in here. They sent their experts down, looked at it. They put money in at $1.50, $7 million. The company now has $11 million in the bank. Same company, same business plan, but in much better shape. So although it was a failure in terms of quality not working, we still own what we saved, we haven't sold, a better company. And they did exactly what they're supposed to do. They raised the money at a high price, etc. One more. This is a recent stock we picked up I'll talk about here. Regulus Resources, exploring a copper project in Peru. Smart guys, high market cap, 156 million, about 15 million cash. Successful group. I worked with the president, John Black, back at Kennecott in Salt Lake years ago. Excellent, honest, solid guys. They've got a resource, just announced a new one, indicated, inferred, decent-sized porphyry, but it's got issues with arsenic and such. So that's not what we're after. Dirty ore, and you can see the land package there. When you cut a cross-section through it, there's a few things to notice here. The package, the land situation is complicated. That's someone else, that's Regulus, that's somebody else, that's Regulus, and that's another. So they've had to do a lot of deals to get this together. The mineralization in this section here, the high part of the section, which is very good grade, but it's also got arsenic, antimony, is nasty ore. So it's something that probably they're not going to be able to sell. So that's not our interest. What we're looking for is what's driving the mineralization we're seeing closer to the surface. And so here are the targets that, I should point out, they're geophysical targets. Number 4 up here, number 1 here. Those are the two that we are really interested in. And this is what they've done drilling-wise. At Roundup in January in Vancouver, they released the results from this hole, testing drill target number 1, 473 meters at 1.39% copper equivalent. That's a nice hit. That's a very nice hole. And you can see, I think I threw the picture in here. As we're getting closer and deeper in the hole, we're starting to see geologically, this is a brecciated host rock with some intrusive mixed in it that's grading really well. You can see this grades 0.5 gram gold and 4% copper. So we're getting close to this thing. That was our interpretation, is we're getting close to it. And the next hole up, this target here, they're drilling it, or maybe they finished drilling it right now, but that's another one that we've liked the looks of because it's much less complicated system or land package and such. So that's what we're watching. So we need to see success on number 1 and or number 4 to stay in this stock. And we know what success looks like. We know what a porphyry looks like. We know the grade that it's going to take. We got a sense that there's no arsenic, so the metallurgy is okay. This is what you have to, I think, this is what at least we do at Exploration Insights, is try and have in back of our mind what it needs to produce to keep us in it, to make it a success. All right, so why bother with due diligence? Find the fatal flaw as soon as possible. These are all stocks that went up real fast. We had a lot of our subscribers asking about it. We'd look into it and declined for whatever reason. This is Camino. You could see this from the air photos, Google Earth, and their photos that this didn't have any size to it. Arizona Silver didn't work. Oryx, we actually owned this one, made money on it, but as soon as the metallurgy started looking bad, they started to pick up more and more manganese, we got out. So we did make money on this one. New Andina, that was an incredible, obvious mistake. Not on our part, but people buying this one. My perennial favorite, Garibaldi. And one that just came out a couple weeks ago, Amex. Just a heads up. Finally, this is an important slide to keep in your mind, this chart, because this is what a lot of these companies do in terms of exploration, in terms of building a mine and such. Ideally, what we want to do is sell out up here. We don't really want to be involved in, this is just Joe and I's philosophy. We don't really want to be involved in companies that are going to build a mine. We'd much rather have them find something so good that somebody else will buy it. Whole different mindset, intelligence, and that sort of thing. So that's ideally what we're after. And if you can put your own portfolio, each stock in your portfolio on this curve somewhere, it always helps. All right, I think I'm about done. Tuesday at 12, Joe and I are on BNN. You can call in and ask questions. It's for an hour. That's the number if you're interested. That's who we are, independent, unbiased, technical commentary. My experience, Joe's experience. I invite you to come to the website. There's lots of information there. And I guess I got time to close out with one more, getting back to the alternative facts and jokes. You can read this. Thank you very much for your time. I appreciate it, and good luck this year.